The question on investors' mind is by how much the Fed will cut interest rates in September. And this week's US CPI data might hold the answer. This is the week ahead. Thanks for joining us at XIM.com. I'm Cristina Marujos, and with me is our lead investment analyst, Rafi Boyajian. Rafi, before we get into the data, though, let's have a look at the only central bank meeting of the upcoming week. The European Central Bank is set to deliver another rate cut when it meets on Thursday. How might the euro respond?
Well, Christina, as you said, we are expecting a rate cut. Of course, the ECB first cut rates back in June. Things didn't go quite as planned back then because, they were basically sort of well telegraphed rate cut. In the last minute, though, there were some data which kind of raised question marks about the timing of a rate cut. But the ECB went ahead anyways. What they did, though, is at the July meeting, they kept rates on hold because the initial expectations were that we were going to have back-to-back rate cuts. Now, those things have started to move more in the ECB's direction, and so it's almost certain we are going to get a 25 basis point rate cut, and most likely they're going to stick to one rate cut every other meeting because at this point there's still some upside risks to inflation because although the headline rate of inflation has now fallen to 2.2%, which is so close to their 2% target, we did see an uptick in services inflation in August, which went up to 4.2%, and that's not good news. If you want to have that confidence that inflation is not only headed to 2%, but it's going to stick around 2%, and there's not going to be much of a risk of inflation starting to rise at some point soon after having, made several rate cuts. So probably the ECB will try to maintain some sense of caution. At the September meeting, we are also going to be getting updated forecasts on CPI and on GDP growth. And should we see downward revisions to these, I think this might be a signal that potentially the ECB is open to cutting rates back to back should the need arise. And probably President Christine Lagarde is that's what she's probably going to try to signal, maybe a more sort of balanced, cautious approach. So she's not going to rule out back-to-back rate cuts or maybe even cutting more, maybe by 50% if the Eurozone economy were to deteriorate because it is kind of struggling at the moment. Some kind of dovish tilt is likely, which may put some pressure on the euro. But at the same time, if there's a risk that she might disappoint in terms of not being quite as dovish as some are hoping her to be, because, for example, the big concern right now is the German economy, which is really underperforming compared to the rest of the euro area. If she isn't quite as dovish as maybe some of the data suggests or some investors are betting, then the euro might gain some ground against the US dollar. But aside from the ECB stance, I think the focus right now is on the Fed. So and that alone is helping the euro to perform quite well in recent months.
Well, speaking of the Fed, Rafi, the US inflation report on Wednesday will probably hold vital clues as to what we're likely to get from the Federal Reserve when, of course, they meet on the 17th and 18th of September. Could this week's data give the Fed grounds for a 50 basis points cut?
Well, that is the big question because we have seen expectations for a 50 basis point rate cut reach around about 40% in recent days. But probably the Fed will stick to 25 basis points. I think potentially out of fear that should they go by 50 basis points instead of 25, then that would be a signal that the US economy is indeed in trouble. At the moment, we are definitely seeing some signs of slowdown, particularly in the labor market, but there's nothing that concrete in terms of, the US economy heading towards a recession. So probably what the Fed is going to do is they're going to cut by 25 and strike a dovish tone. So it's going to be a dovish cut as opposed to the hawkish cuts we got out of the ECB and the Bank of England. And that could put more pressure on the US dollar. So even if we were to get a weaker than expected CPI numbers, I think there would have to be a very weak CPI report for the Fed to be able to justify amongst themselves, Fed officials amongst themselves to go by 50 instead of 25. But nevertheless, CPI report that's on the soft side is definitely going to put the US dollar under more pressure in the run up to the September FOMC.
And finally, let's look at the pound. Rafi, it's been quite resilient this summer, one could say. How could we see it perform, of course, this week on the UK jobs and GDP data?
Indeed, the pound has been rather resilient actually all year. In fact, even when the US dollar was at a strong point this year, the pound actually avoided, going into year-to-date losses against the greenback. And part of the reason for that is because we've seen a fairly solid rebound in UK economic growth in the first half of 2024. Whilst there's been some weakening in the labor market, wage growth, it's kind of stayed elevated in the last two reports. We've seen some impressive progress, or some much needed progress rather, in terms of wage growth moderating enough for the Bank of England not to be so worried about it. But nevertheless, we're not quite there yet in terms of the Bank of England to cut rates, say, every meeting. So in September, the Bank of England might buck the trend and actually keep rates on hold. The question is, will the upcoming data make much difference to those expectations? We are going to get the jobs data first, and then it's going to be followed up by monthly GDP numbers. So unless there's anything worrying in the data in terms of the UK economic rebound kind of stalling or going into reverse, I don't think it's, we might see some choppiness in sterling, but overall, I think what's going to be more important for the pound is the CPI report in the week after, when it comes to rate cut expectations.
Rafi, thanks so much. This was The Week Ahead here at XM.com.